If you're investing for retirement, there's a financial question that deserves a clear answer. Is your portfolio built to support the life you want in retirement? A lot of smart, successful people find themselves wondering, am I doing this right? By the end of this video, you'll have a much better understanding of how to build the right investment mix for you, so you'll feel confident, prepared, and in control. Let's get you some clarity. Your investment mix determines two things. One, how much potential it has for growth, and two, how much fluctuation it's likely to exhibit along the way. When you're investing for retirement, you need enough growth to keep you ahead of inflation and also enough stability so the market drops don't keep you up at night. So how do you figure out a suitable mix for you? Let's start with a quick self-check. Answer the following questions honestly. There are no right or wrong answers. Question 1, how do you react when the market drops 20%? A, I barely notice, it'll recover. B, I get uncomfortable but stay invested. Or C, I want to sell before things get worse. Question 2, when will you begin drawing on this money? A, not for at least 10 years. B, 5 to 10 years from now. Or C, very soon. Question 3, how long does this money need to last? A, 20 years or more. B, 10 to 20 years. Or C, less than 10 years. Question 4, which matters more to you? A, higher long-term rate of return. B, a balance of growth and stability. Or C, not losing money, even if your returns are lower. Got your A's, B's, and C's? Good. Hold on to those. We'll come back to them in a minute. Before we talk about what your answers indicate, you deserve to know how your choices impact you. Historically, over long periods, a diversified portfolio of stocks like the S&P 500 has averaged something like 10% per year. Diversified portfolio of bonds has averaged about 6% per year, and cash has averaged about 3% per year. Inflation, by the way, has also averaged about 3% per year. So stocks, over the long term, have offered investors the most long-term growth potential, which helps your money last as long as you do. But you've lived long enough to know there's no something for nothing. There's no free lunch. There's got to be a price to pay if stocks have a higher rate of return than bonds or cash, and there is. You have to be prepared to endure significant short-term price fluctuation along the way. When your investments decline in value, as they will from time to time, that does not mean you've lost money. You only lose money if you sell while it's down. Imagine you bought a house for $1 million, and then the housing market goes south, and you find that if you were to sell it, you'd only get $700,000. Here's a question. Did you lose money? Right, you only lose money if you sell the house during the downturn. If you hold it, live in it, and sell it sometime in the future for $2 million, you didn't lose a penny, but you did experience a significant amount of short-term price fluctuation. A diversified investment portfolio can feel the same way. How much of your portfolio is in stocks versus bonds will impact your rate of return and how much it will fluctuate. So let's say you have 100% of your portfolio in stocks. I said stocks over the long haul have averaged about 10% per year, so your rate of return might be 10% per year. If you had 100% of your money in bonds, earlier I said the long-term rate of return on bonds has been 6% per year, then your rate of return on a 100% bond portfolio would probably be something like 6% over the long term. Now, so what if you do a split? What if you were to put 50% in stocks and 50% in bonds? 50% has averaged 10, 50% that's averaged 6. Your rate of return is going to be the blended weighted return, something like 8% per year average over the long term. And if you add cash to the mix, that's likely to bring down your rate of return again. I said that cash has averaged about 3% per year over the long term. So if you had some money that's averaged 10, some money that's averaged 6, and some money that's averaged 3, again, it's going to pull down the rate of return. It'll also probably mean the portfolio fluctuates less. So the key question becomes, how much growth do you want or need, and how much short-term price fluctuation are you willing to endure along the way? Your quiz answers help point us in the right direction. Let's connect your answers to a portfolio approach. If you answered mostly C's, you're a conservative investor. You're probably going to want to have most of your portfolio in bonds and a smaller relative portion of it for growth in stocks. You'll notice that I'm leaving cash out. Here's why. We all need to have cash, but probably not in our retirement account. We want to have cash for short-term needs, for liquidity, and to help us ride out downturns in the market so we don't have to sell our stocks or bonds if they're temporarily down in value. But a retirement account, by its nature, may not be as liquid as other types of accounts. So you're probably going to want to have your cash or your emergency fund, your short-term cash, in non-retirement accounts, maybe an individual account, a joint tenant account, or a trust account. If you answered mostly B's, your objective is a balance between growth and stability, a very common fit for retirement investors. Maybe something like 65% in stocks and 35% in bonds. If you answered mostly A's, you're an aggressive investor. You're focused on growth, and you're comfortable with the short-term price fluctuations that go with it. You're going to want to have most, if not all, of your money in stocks. Now, there is no single right mix for everyone. Understanding your goals, time frame, and tolerance for short-term price fluctuation, that's how we find the mix that may best support your retirement. The questions you answered are just examples of a more complete analysis we use at Atterbury Investment Management. If you'd like the full version of the risk profile questionnaire that we use, just write profile in the comments below and I'll send it to you. And if you'd like a professional review of your investments and retirement strategy, reach out. I'll leave a link in the description below for scheduling a no-cost, no-obligation consultation. Now that you have a better understanding of diversifying between stocks, bonds, and cash, watch this video next for a deeper dive on how to diversify among different types of stocks and bonds. Thanks for watching. See you in the next video.